Hey there, it's Justin again. Now that you understand what taxes are and why they exist, we could focus more on how they're going to directly impact your life as a working adult. In this lesson, you'll learn about the different types of tax systems and which system we use in the United States. So by the end of this lesson, you will be able to calculate tax liability and tax burden and use those measurements to compare the three types of tax systems. To reach that goal, first we'll have to learn the two ways that the cost of taxes can be measured. Then we can use those measures to compare the three types of tax systems: regressive taxes, proportional taxes, and progressive taxes. The cost of taxes on taxpayers can be measured two ways: as tax liability or tax burden. Tax liability is the actual amount of dollars owed. If you did your taxes at the end of the year and found that you made $47,950, the total amount you'd owe in income tax could be $4,000. That would be your tax liability. Tax burden measures the percentage of a person's income being taxed. $4,000 in taxes could be a tiny drop in the bucket for one person and a huge source of stress for somebody else. To measure tax burden, we divide the tax liability by income. So, for that person who owed $4,000 on an income of $47,950, their tax burden is 8.3% of their income. Okay, so now that we know how the real cost of taxes can be measured, let's use those measurements to compare tax systems. There are three categories of tax systems: regressive, proportional, and progressive. For each category, we'll learn how the liability and burden affect different people, then go over some examples. In the notes, you'll find additional examples to practice comparing tax systems. A regressive tax system is one in which tax liability is the same for everyone, but that results in the tax burden being much higher for poor people and much lower for rich people. A tax liability of $1,000 is a much larger burden on somebody only making $20,000 a year than it would be for somebody making $2 million a year. This is a major criticism people have of regressive taxes. They disproportionately affect the poor and are barely even noticed by the rich. Examples of regressive taxes would be any tax that is the same for everybody regardless of income, like sales tax, which is based on what you buy, not on how much you make. Cashiers don't ask you for your income before telling you your total. Sales tax is different in every state, but in this example, it's 8.7%. So anybody who buys $8.48 worth of stuff will be charged 8.7% of that, or 74 cents, which gets added to their total. Admission fees at museums are another example. They cost a flat dollar amount no matter who you are, which can keep lower income families from being able to have a fun educational experience. Another example that causes a lot of stress for some people are property taxes. With property taxes, people whose homes are worth the same amount will pay the same in taxes, regardless of how much they make. Whether the homeowners are a retired couple who have finished paying off all their loans, or a family that struggles to save money because they still have a mortgage and car loans to pay off, they will both be asked to pay the same in property taxes each year. Check your notes packet for an example you can work out to see how property taxes would affect these two families differently. It's worth noting that property taxes are set by the state governments and are not the same across the United States. If these two families lived in the same state, they would have the same tax liability for the same house. But if they lived in two different states, then their property taxes could be very different. If regressive tax systems seem a little unfair to you, some people suggest a proportional tax system instead. Proportional taxes are calculated as a percentage of everybody's income, resulting in an equal burden for everybody. Supporters of proportional taxes say that they give people more reason to work hard and earn more since their tax burden won't change even if they get rich. An example of proportional taxes is the Social Security tax. Social Security tax is taken out of every paycheck at a rate of 6.2%. If you make $1,000 a month, you're taxed $62. If you make $10,000 a month, and $620 will be taxed. Always the same proportion, so it places an equal burden on everybody. At least in theory. That person making $1,000 would only be left with $938 to get through the month. For somebody making so little, every cent counts. That $62 may have been needed to pay bills or buy food. For the person making $10,000, they could lose $620 and still have over $9,000 left to pay their bills with, so they're a lot less likely to notice the missing money. For this reason, some people consider proportional taxes to be another form of regressive tax because they believe that the impact is still higher on the poor than on the rich, even if the tax burden is identical. Another example of a proportional tax is Medicare tax. Through Medicare tax, every employee's income is taxed at a rate of 1.45%, and that money is used to help cover medical costs for the elderly and those with disabilities. The final tax type is a progressive tax. With progressive taxes, tax burden increases as your income does. It's basically the opposite of regressive taxes. Progressive taxes are often criticized for discouraging people from working harder because more income means a higher tax burden. But others praise progressive tax systems for putting more of the burden on those who can afford it instead of those who can't, which was the major criticism of both regressive and proportional taxes. Let's look at some examples so you can decide for yourself. The largest example of a progressive tax in this country by far is income tax. The way our income tax system works, people with higher incomes pay a higher percentage of their income in taxes. Let's say somebody makes $21,000 a year. Their tax liability might come out to $805 for a burden of 3.8%. A person who makes $80,000 a year could be taxed for a total of $10,368 for a tax burden of 13%. Somebody making $155,000 a year might owe a little under $28,000, or about 18% of their income. You get the point. You earn more money, you're taxed at a higher percentage. The logic behind this is that those with more money are thought to be able to afford higher tax burdens without feeling the effects as much. There's actually a lot more to it, but you'll learn more about that in our video on tax brackets. Earned income isn't the only income taxed progressively. Some other examples are interest income, or income you receive as interest from loaning money to others, and rental income from renting out your property. When you file your income taxes, all of these will be rolled into one. Time for a quick review. Regressive taxes, such as the sales tax, place equal tax liability on everybody. Proportional taxes, like Social Security tax, place an equal tax burden on everybody. And progressive taxes, like income tax, ease both the liability and burden on lower earners by taxing higher earners at a higher percentage. Each system has its benefits and drawbacks, and which one is fairest depends on your definition of fairness. So, which of these do we have in the United States? Well, you may have already noticed this, but every example we mentioned in this lesson was an example from our own tax system. In the United States, a little bit of each tax style is mixed together, but the majority of tax revenue comes from income taxes. So our overall system is considered a progressive tax system. When you hear people complaining about how complicated taxes are, they're talking about income taxes, because a lot of math goes into calculating how much you owe based on your income. In the next lesson, though, I will show you the first step in doing your own taxes, calculating how much of your income is actually taxable. See you then.